Well, for more on this, let's bring in Torsten Slock, chief economist at Deutsche Bank. And Torsten, we just heard from Brian breaking down all aspects of this report. Let's start with the market's reaction, because we can see the Dow, the S&P, and the NASDAQ all trading to the downside. Simply put, is this the market interpreting good news as bad news in terms of the Fed's potential next move?
Absolutely. I mean, so the headline number, as you just spoke about, was a lot better than anyone expected. But it still is a little bit unclear exactly how the Fed is going to react to this. As Brian just mentioned, there was priced in 50 basis points cut by many people, and that's now been basically taken out. So now the discussion is, will they cut 25 basis points or will they not cut at all? And if they don't cut, then maybe equities here are looking at that and saying, well, maybe that's not what we expected, and that's why the market might be a little bit disappointed today.
Torsten, what are you expecting in terms of the Fed's next move? We know that the 50 basis point cut is, a lot of economists are now saying that that is off the table, like you were just alluding to, just in terms of the shifting in terms of opinion right now. But what do you think the Fed is most likely to do next?
It's a tough call. I mean, we get inflation next week. At the end of the day, the Fed has a dual mandate of full employment and inflation. And therefore, the inflation numbers next week are going to be pretty important. The CPI is normally a very critical driver of the way that they talk about things. So the answer to your question is stay tuned. At this point, we still think that they will cut. It's a close call, but a lot still is riding on the fact that inflation has to show this relatively benign picture that we've seen for quite some time, namely inflation being a little bit weaker and not being a problem. That would certainly open the door more for the cut to come through. But a very critical part of this debate is that the labor market, we had all thought, and this is also what Brian just mentioned, that the trade war was going to weigh more heavily on the economy. We've seen that in ISM, as Brian also mentioned. We've seen that in a number of other indicators in CapEx spending. We've seen a number of the regional Fed surveys for CapEx plans. But the numbers today, both in hiring and manufacturing, but also in the services sector, manufacturing is about 10% of GDP, 10% of employment, but the services sector is doing just fine. So therefore, 224 on non-farm payrolls. It tells you that the economy is doing okay. And with that backdrop, you really can ask the question, should the Fed do anything? But the downside risks are still here. So it's a little bit of a tricky situation. We still need a bit more information. And the good thing for the Fed is that there is still a few weeks here before we get to the end of the month, before they need to make the decision.
Torsten, focusing on the inflation story, one figure that a lot of economists are zeroing in on today is wage growth. We had wage growth up 3.1% year over year. When you take a look at that number, I mean, that it's slowing growth. It's actually, I guess, fair to say it's going sideways at this point, kind of feeding into that low inflation story. How important is it to get wage growth up in terms of extending this economic expansion that we've been on now for quite some time?
Yeah, this is really important because for the last few years, wage growth has actually gone up quite nicely. And that, of course, is good because the more money people have in their hands, the more they go out and consume. The problem is that today, underneath the very strong headline number, if you multiply together the number of jobs with wages, with also the number of hours worked, you do get the number which tells you something about what is total labor income. In other words, what is the total amount of money that people have in their hands for consumer spending? And the problem is that that started to dip down a little bit, and we get a little bit worried that maybe labor income rolling over, at least flattening out, but potentially even starting to point a little bit down, is a little bit of a warning sign that the labor market is less overheated, and therefore also the labor market being less overheated, less strong, is also telling us that we better be a little bit alert on what does that mean for consumer spending. So the answer to your question is that yes, it's true. Wage growth starting to move sideways. As much as wage growth is moving sideways at a reasonably elevated level, we are a little bit worried again about some of the downside risk. For that means most important to consumption. And remember, as you know too well, consumption is 70% of GDP. So it does mean that the outlook is still that the economy is doing fine, but there are a little bit of a sign here that maybe we should be alert still to the downside risks above and beyond what's going on with the trade war.
Torsten, is it surprising to you that we're not really focusing on the fact that we had May, which was already a very weak report? We actually saw that revised even lower, down to 72,000 jobs added to the economy. April was also revised lower. So the combination of the 2 months, the total was lowered by just around 11,000 jobs. Is this something that Wall Street should be paying a little bit more attention to?
It's a relatively small number, 11,000. So the fact that it continues to be more than 200,000 in the latest reading still is what I think should get most attention. But I mean, the overarching story that you have covered so well, and we have talked a lot about also here is, of course, what has been impact of the trade war. And what has been the impact of the trade war up to this point? I mean, the trade war has been going on now for essentially, basically a little bit less than a year. And you still then lean back in your chair and ask the question, given that the trade war has been intensifying and also was pretty intense again in May and in June because of the Mexican tariffs and everything else that came and then went away again. It is pretty impressive that the economy is so resilient. It is fairly strong numbers that we're still seeing despite these headwinds coming from the trade war uncertainty that's weighing on the manufacturing sector.
Torsten, speaking of the trade war, I mean, there's yet to be signs that we are any closer to reaching a deal. I know the markets initially interpreted the outcome of G20 as somewhat positive for the markets, but we got additional comments from Trump this morning, basically blaming China again. How long can the market, do you think, and the economy overall kind of shrug this off and be okay? When will we start seeing some of this reflected in the economic data?
Yeah, this is what the Fed and we and the consensus and everyone is wrestling with, because the whole problem with this is that, I mean, you can easily quantify some shocks if the dollar goes up or if the commodity price, the oil prices go down. But here you have a shock that really is all about what is the political decision on the US side, what's the political decision on the Chinese side, and we really don't have a good model for forecasting that. So in some sense, it really is all a function of how far do you think the trade war will go in terms of how much will it escalate from here? All other people we talk to basically sometimes say, no, we think will de-escalate. So in that sense, it really is, in terms of the consequences, really important to have some idea about, well, what are we going to see in terms of how far will the trade war go, or meaning go escalate or de-escalate? And given we don't really know the answer to that, and no one really may know the answer to that where we sit today, then this is certainly the number one fear that we are watching and that we have in all our client conversations about what is the end point in the trade war, and do we have the worst behind us? If that's the case, then you should buy more stocks, you should buy risky assets, credit, IG, high yield. If you think that the escalation of the trade war is still going to get worse and we'll have more ahead of us, then it is certainly worth waiting a little bit before you put on more risk and buy more equities. So that's why it really is a debate about how far we're going to go with the trade war from here.
All right, Torsten Slock, Chief Economist at Deutsche Bank. Thanks for joining me today.
Well, thanks for having me.